So today's topic is a game changer when evaluating monetary policy. So we're going to be looking at liquidity traps. So what is a liquidity trap and why is it useful when evaluating monetary policy? Well, a liquidity trap will occur after a significant economic shock. And as we'd expect, the central bank would use the bank rate, so think about the transmission mechanism, as a reaction to try to stimulate growth. The only issue is, and this is where the liquidity trap comes in, is sometimes this doesn't work. And we're going to be in this video exploring, well, why might it not work? So if the central bank has already used tools like forward guidance, they've already made reductions in the bank rate, and in fact, those reductions, sometimes we can see sharp declines, and that, when it hits a certain level, is when we start to see the liquidity trap. So what is this level? So it's the zero bound level, which is pretty much at zero. It can't really go any further. We could possibly try negative interest rates, but it's quite controversial. The UK has never done it. Only a couple of countries have. And I'd say it's probably not tried and tested. But the issue is that even at, for example, zero, it's not stimulating the borrowing that is needed to obviously help that economic activity. So why? Well, first of all, we have to look at three economic agents. We need to look at the financial sector of commercial banks. We need to look at firms, and we need to look at consumers. So the bank will reduce their bank rate, hoping it'll filter through to the market rates in terms of what the commercial banks offer. But for whatever reason, that just doesn't seem to be happening. And banks seem to be quite risk averse. They're concerned about lending at this time in terms of at the rates that maybe the central bank is trying to promote. So they're still offering higher rates even when the bank rate is falling. Secondly, firms don't seem to be wanting to invest. So therefore, if you're not wanting to invest, it's going to mean that there's reduced borrowing for firms. Why are they not? Well, probably because they've got large spare capacity. They're not utilising their current capacity, so why would you increase that capacity, especially if your expectations remain negative? So what firms probably need is some reassurance. They need to see some economic activity, because without that economic activity, they're not going to want to invest at this moment in time. And finally, consumers. Well, you might argue low interest rates. Think about the opportunity cost of saving. Like, why would you save? There's no encouragement to save. But if they've got job insecurity and they've got low confidence, they might worry about further cyclical unemployment. So even with, for example, zero rates, they're still hoarding cash just in case. So it is not stimulating the economic activity that's required to boost actual growth. So as we see, as the money supply shifts right, the interest rate hits the zero lower bound, but it can't fall any further unless, like I said before, with controversial negative interest rates. As I mentioned, it is seen to be controversial. It can erode, for example, commercial banks' profitability because you're charging on that saving. But anyway, I don't want to drift off point. With a liquidity trap, confidence is missing, so demand doesn't really rise. So a quick analogy, see the door, this broken door is the economy. The first steps from the central bank is to try that door handle. The door handle is that bank rate. It might help a little bit, but it's jammed. So it's not good. It's not necessarily going to help fully open that door. So what they need is they need something else. That might be another central bank policy, or it might be the government, but I'm going to touch upon this later on in this video. I think it's always great to have real world examples. So I think Japan in the 1990s is a good example. So they faced a pretty severe liquidity trap. It was for a period of time, and then also they experienced more economic shocks, which didn't help. So Japan actually was a country that tried negative interest rates, and some of that was because of the liquidity trap they were experiencing in the 90s and what continued, for example, after the financial crisis. So talking about the financial crash, we've also got liquidity traps being experienced by the UK, the US, EU post 2008, and some of that was contributed towards the austerity measures that were also put in place because obviously they were contractionary. They didn't really help recover growth and confidence. So remember, what is absolutely crucial about liquidity traps is this idea of confidence. If confidence is literally next to zero, then we've got more chance of this liquidity trap taking place. So what might we need instead? So as I mentioned, in the UK, austerity didn't help because they were focused on fiscal discipline and they were not supporting the growth of the economy. So what we might need is, if we're experiencing a liquidity trap, is we might need the government coming in and trying to stimulate growth and boost confidence. So just think about Keynes and his crowding in effect. So if he's trying to crowd in the private sector and stimulate private sector spending, the government might play a role in that via their expansionary fiscal policy. If it's not the government and it's still the central bank, then QE might happen. And the reason why QE might make a difference, so even though obviously QE reduces long-term interest rates, QE, it does inflate asset prices, which can cause obviously a positive wealth effect. That positive wealth effect can also improve confidence. So what we're looking for is anything that can try to support the growth in confidence, which can also help to make expectations become positive, and then people might start to borrow again.